Today I would like to analyze Kering, one of the biggest luxury companies in the world. So they are mostly known for owning Gucci, Saint Laurent, and also Balenciaga. If we take a look at the stock price, we can see we had a very bad performance in the last 5 years, around minus 67%. So we're going to take a look at the financials to find out if this company is undervalued right now. The first thing we can recognize is a market cap of 20.94 billion euro. So we can see here this is the seventh largest luxury company in the world by the market capitalization. We also have a dividend yield of around 3.6%, which we can see here. We had some increasing in the last 5 years, but also some cutting of the dividend as well. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. You want to invest in a growing business and not a declining business. So we can see here in 2020, the revenue was around 13 billion euro. This was a 17% decline from 2019, so probably related to COVID. Then in 2021, we had a strong growth around 34%. 2022, we had the growth around 15%. Then 2023, we had the decline around 4%. And 2024, we had the decline again around 12%. So this is something we don't like to see. 2 years in a row, we had the decline. But I would still say it's a check here because overall in the 5 years, we had some growth. The next thing you're looking for is free cash flow growth in the last 5 years. The free cash flow is a very important number because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So we want to see that grow, and we can see here in 2020 the free cash flow was around 2.1 billion euro. This was a 27% increase from 2019. Then in 2021 we had a strong growth around 86%. This is something we like to see. 2022, we had around 18% decline. 2023, around 42% decline. And 2024, around 24% decline. So this is something we don't like to see. 3 years in a row, we had the free cash flow decline. And this is not a check because in the last 5 years, we didn't have the free cash flow growth. What I think we shouldn't only look at the free cash flow, we should look at the operating cash flow as well. We can see here we had some strong growth in 2020, in 2021 as well. Then 2022 we had a 12% decline. 2023 the 4% increase, and again 2024 the 5% increase. So what's the difference between this and the free cash flow? So we can see here the main difference is the capital expenditures. This means the company investing in the business. Maybe they buy other brands, maybe they buy properties. So we can see here the capital expenditures increased significantly. So this made the free cash flow decline in some years. So I think it's not a bad thing. I also saw this company buying some other brands and also buying some property. So I think if the capital expenditure will decrease in some years, the free cash flow would be way higher. So overall, I think it's not a bad thing that we see this here. The next thing I'm looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So what we're going to do now, we're going to take the free cash flow from 2024, so around 1.4 billion euro. We're going to divide it with the current market capitalization. We're going to take the 21 billion. Then we're going to get the free cash flow yield of around 6.67%. This is a good free cash flow yield. It's over 4%, so it would be a check here. This is something we like to see. We should also make some assumptions about the future of the free cash flow. So we can see here, we asked ChatGPT, the free cash flow could be around 2.3 billion euro in 2025, around 2.4 billion euro in 2026, and around 2.6 billion euro in 2027. So I think this could be realistically, because we can see here actually the operating cash flow is around 4.7 billion euro. So then we have the extreme high capital expenditures of around 3.3 billion euro. If they make the capital expenditures lower in the future, I think the free cash flow could be over 2 billion euro. So let's just assume in 2027 we can reach around 2.5 billion euro. Then we're going to take the current market capitalization of 21 billion. And then we're going to get the free cash flow yield with the assumptions. So the number we get is around 11.9%. So this is a very high number. It can be an indication that this company could be undervalued right now. The next thing we're looking for is the debt to free cash flow ratio under 5. So this means the company can pay back the debt with the free cash flow in under 5 years. So this is a very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So we don't want to see that. Now we're going to take a look at the long-term debt first. So we can see here the long-term debt is around 10.5 billion euro. We're gonna add the short-term debt as well. So we can see here the short-term debt is around 1 billion. Then we're gonna add this number as well, 2.4 billion. So all in all is around 3.4 billion. Then we're gonna divide it with the current free cash flow. So the current free cash flow is around 1.4 billion. So the number we get is around 9.9. So this is not a good number in my opinion. It's quite high. This means the company can pay back the debt with a free cash flow in a little bit under 10 years. So this is not a great number, another check here. But we can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 3.5 billion euro. This is a good number, so they can use this to pay back the debt or to invest in the business. But overall, I think the balance sheet doesn't looking so great. They have quite a lot of debt. But if we consider that the free cash flow could be around 2 billion or 2.5 billion in the next years, then the number would look differently. So I can calculate this quickly as well. So if we assume that the free cash flow could be around 2.5, then we would get a number here of around 5.56. So then the number would already look better. So I think the balance sheet is not great, but if they can grow the free cash flow again, I think the balance sheet would be okay. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. So first we're going to calculate the enterprise valuation. So this is the market capitalization plus the debt. So the debt was around 13.9 and minus the cash, so 3.5. So this is a more accurate valuation system, I would say, because it includes the debt and it also takes off the cash. So this is a very important number. Then we're going to divide this number. So let's calculate this number first. So the enterprise valuation would be around 31.4. So this is the enterprise valuation. This is how much the company would cost all in all. Then we're going to divide it with the current free cash flow. So let's take the number 1.4 billion. So then we're going to get a number. The number we get is around 22.4. So this number is under 25, so it would be a check here, but it's also not a very great number. There are other companies who have the number around 10 or 15, so this would be then an extreme undervaluation. But I think this company looks not incredible undervalued from the free cash flow perspective, but let's assume that they can increase the free cash flow again in the future. And I think this could be realistic because they have a very high capital expenditures. So let's say the number would be around 2.5 billion in free cash flow. So then we would get a different number. So the number we would get is around 12.56. So this would then look undervalued to me. This is a great number. So if you expect this company to have the free cash flow growth again, I think it does look undervalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that when we think the company is undervalued. So we're going to take a look here and we can see the shares outstanding did decrease many years in a row since 2018. Sometimes they had over 1% in buybacks, but now we can see here in 2024 the shares outstanding did increase. Is this a bad thing? I think it's a positive thing because the balance sheet is not looking very good. So if you have a bad balance sheet, I think you should not really buy back your own shares because you should use this money to invest in the business or to pay back your debt. So it's not a check here, but actually this is a good thing. I think they should not buy back their own shares right now. I would like to give my conclusion about this company. So let's start with a positive. So we have a free cash flow yield of around 6.67%. This is looking quite good. So if we assume that in 2027 the free cash flow could be higher, then we would have a free cash flow yield of around 11.9%. This would look undervalued to me then. The enterprise valuation to free cash flow ratio around 22.4 is for me not looking for extreme undervaluation, but maybe around fair value. If we assume that the free cash flow can increase, then the enterprise valuation to free cash flow ratio could be around 12.56 in 2027. So the next positive thing would be operating cash flow increase. So this is a good thing. It can show that the business can still growing and still be profitable. But the balance sheet is not looking great. This means we have a lot of debt and not a great amount of cash on hand. We also have a revenue decline and we have a free cash flow decline. So overall, I think the free cash flow could increase again in the future if we make the capital expenditures lower. And of course, if this company can selling a lot of products, this is the main reason for the free cash flow decline as well. So overall, I think we need to see how this company can perform in the future. I think right now with the tariffs is a difficult situation, but I think this company also had a lot of potential. They have good brands, and I think if they have less capital expenditures, the free cash flow would increase again, and then probably the company could be more popular again. So overall, I think if you believe the free cash flow can increase, this company could be a good buy right now, and it does look undervalued if we consider that this company already had a very high in 2021, so it's dropped around 77%. So this is a big drop, and I think if the free cash flow has an increase again, we can see the higher stock price as well. If you found this video helpful, don't forget to like and comment and subscribe for more content.